Hello and welcome to the weekend edition of the Daily Brief. Here we replay the top stories that we've covered throughout the week for those who couldn't catch up during the week. So let's begin.
A few days ago, India initiated an anti-dumping investigation on imports of steel products coming from Vietnam. The reason is Vietnam is said to have been dumping their steel products in India, and the domestic steel players don't like this at all. Companies like JSW Steel and ArcelorMittal Nippon Steel are concerned that these cheap imports are damaging their business by making it hard for them to compete. This is because they cannot match the prices of Vietnamese steel makers. So to solve for this, India has launched an anti-dumping investigation into hot rolled coil or HRC steel imports from Vietnam. Now for your context, HRC is a type of steel that is used to make things like car parts, building structures and machinery. Now while this seems like a good step, the thing is India does not really import much of its steel from Vietnam. The real problem is China. India, like many other countries, relies on China for a lot of things, especially steel. According to S&P Global, in July alone, Chinese steel is expected to represent 73% of the total steel imports. Now see, over the last few decades, China has become an economic powerhouse largely because of the massive government investments in infrastructure. China has spent massive amounts of money on constructing everything from highways, railways, power plants, heavy industries to even massive urban housing projects. And this has helped China industrialize rapidly and has turned it into an export powerhouse and the world's factory. Now all of this obviously required a lot of commodities, particularly steel. Now in order to make all that steel, China needed vast amounts of iron ore, which is the main raw material for steel production. As China kept building and expanding, it became the world's largest consumer of iron ore. This huge demand pushed iron ore prices to record levels over the last 25 years. But things have started to change now because China's economy is no longer growing as fast as it used to at one point in time. As a result of this, China no longer needs as much steel as it once used to require. China has now ended up with a lot of excess steel production capacity, and they need to do something with all this steel being produced. In fact, the world's biggest steel producer, which is based in China, said that the conditions in China's steel sector are like harsh winter that will be longer, colder and more difficult to endure than we expected. And that is definitely alarming. So where does all this surplus steel go? See, like I mentioned in the beginning, they dump it in countries. But the biggest problem with this dumping is that everyone in the world may start becoming dependent on just one country. And the result of that could be China becomes even more powerful in global trade. And that is a big risk. Why, you may ask? See, China's dominance in global trade means they could start using their power to push other countries around. For example, if China decided to stop selling certain materials or products, these countries would be in big trouble because they rely so much on these imports. Also, since China produces so much more than it requires, it can sell its products very cheaply, which might push domestic companies to go out of business because they just cannot compete with others. Chinese steel imports are affecting steel prices already. In mid-July, Chinese cold rolled coil or CRC, which is used for making things like home appliances, car body panels and furniture, was sold to Indian importers at $610 per metric ton. Even after adding a 7.5% import tax, the Chinese steel was still over 4,000 rupees per metric ton cheaper than the same type of steel made in India. But it is not just India that is facing the heat. Other countries have joined on this too. Brazil has set a limit on how much steel can be imported from China. If more steel is imported than the allowed quota, the extra steel will be taxed at a much higher rate. They are doing this to protect their local steel industry from being hurt by the flood of cheap steel from China. Now this phenomena isn't just restricted to the steel industry, but various other sectors as well. US and Europe have been imposing tariffs on goods from China, especially on things like electric vehicles, to protect their own industries from being overwhelmed by cheap Chinese imports. For instance, in US, Joe Biden recently announced 100% tariff on electric vehicles and 50% tariff on semiconductors and a 25% tariff on EV batteries imported from China. Europe also decided to impose extra temporary tariffs of up to 38% on EVs imported from China. Now this is a very fascinating trend that is shaping up now, and I'll be sure to explore more about it in the future. Moving on, let's talk about how the private sector in India is hot once again. See, most of us hear the word GDP almost every day, but not many of us know what it really is. See, simply put, GDP measures the amount of economic activity in a country. It is made up of what the country's people spend, what its government spends, what people from abroad spend in the country, and finally also investments. See, a large portion of this GDP calculation is investment. Investments are also important because they are a leading indicator of the economy. In simple words, this means that higher the investments, the higher is the growth that is expected in the future. Now, these investments can be made either privately or by the government. Now, something that the current NDA government has done very well is ramping up infrastructure related investments in our country. In fact, over the last few years, government capex has been pretty much the biggest reason why our economy has been growing. Private investments have barely changed. But there is some reallocation happening here. Even though government investments are increasing, if you break things down, while direct investments by the government are going up, PSUs or public sector companies are reducing their capital expenditure or money they spend on expanding capacity, building new plants, etc. According to a Motilal Oswal report, from about 2.3% of the country's GDP in FY 2020, PSU investments have fallen to 1.2% in FY 2023. Another very interesting fact is that PSU capex was only 40% of the central government's capex in FY 24, but about 10 years ago, it was almost 150%. Now, this means a lot of government investments is being made directly instead of being routed through PSUs. Now, this could be intentional because PSUs are largely inefficient, or could also be for another reason we can't be sure. Now, in an ideal situation, government infrastructure investments should be followed by private investments. Think about it. If the government builds a road from point A to point B, in an ideal scenario, it is only useful for the economy if people on the A side can start trading more easily with people on the B side. So you would expect that after the government's investments, a lot of private investments would follow in order to facilitate this trade. But very strangely, since 2011, this has not happened. Until 2011, our private investments were quite high and were consistently rising. They rose from around 10% of our GDP in the 1980s to around 27% in 2007-2008. But since 2011-12, they have begun to drop almost in a straight line. In 2020-2021, our private investments hit a record low of 19.6% of our GDP. Some economists suggest that investments dropped because India's private consumption expenditures are low. But maybe there's another prominent reason. In one of the older episodes, I had referred to an editorial by economists Josh Feldman and Arvind Subramaniam. To give you a quick summary, they said that investing in India can yield great returns, but it also comes with very strange risks. They said that in India, there is always an off chance that your investments will suddenly lose its value because the government policies could turn away from you. To make things worse, this risk is not just for the future, but could also be applicable retrospectively. Something similar had happened with Vodafone and a few other companies back in 2011, and that very thought may be scaring private investors away from investing in India. But according to a recent report from the RBI, private investments in the country seem to be picking up once again. In FY 2023-2024, private companies managed to raise 5.6 lakh crore rupees from banks, IPOs, and external borrowings for 1,505 projects as compared to 3.5 lakh crores in FY 22-23 for 982 projects. Now that is pretty good considering everyone has been cribbing about the lack of private investments in the country. Now it's not that all of this 5.6 lakh crores will be spent in the same financial year. These investments happen in phases over multiple years. Of this total money that is intended to be invested, the expected capex for this financial year is expected to increase substantially from 1.59 lakh crores in 2023-24 to 2.45 lakh crores in 2024-25. Now do remember that these are just investment intentions and not final investments. This means some of these investments can fail to materialize. There is also the fact that project estimates are revised upwards and downwards, or there could be significant delays. But that said, investment intentions do serve as a very important early indicator. It gives us a directional sense of whether the private sector is even thinking about investing. So fingers crossed. Moving on to the next story, let's talk about the past, present, and the future of the Indian economy. C. Rangaraj is one of the most distinguished economists we have ever had in India. He has served a variety of roles, ranging from an economic advisor in the UPA government, governor of multiple states, a member of parliament, and most famously as the governor of the RBI from 1992 to 1997. And this was a period during which India was facing massive economic crisis and was liberalizing its economy and opening up to foreign investments. He is 91 years old now, which means he's pretty much seen the entire independent India's economic journey. On Independence Day, he gave an interview to CNBC TV 18 and he shared many fascinating insights about our economic history as well as the present day. I want to share a few things that I found very fascinating. First, speaking of the history of economic reforms, Dr. Rangarajan said that in the 1950s, for a poor, underdeveloped country like India, there was no clarity on what path it could take to develop economically. The Indian economic strategy included four key elements. First, increasing savings and investment rates. Second, is a dominant role for the state in the economy. Third is import substitution on policy or trying to manufacture everything at home. And the fourth is the focus on industrialization, especially heavy industry. But by the 1970s, it had become evident that this strategy would not work. India had to make a change to this economic strategy, but policymakers missed the chance. It would take us another 2 decades to implement the harsh reforms that were required. So in 1991, India experienced a balance of payments crisis. Simply put, at the end of 1990, India only had foreign exchange reserves to finance 3 weeks worth of imports. For comparison, India has forex reserves of $670 billion today. So in 1991, India had to pledge its gold, devalue the rupee twice, and then liberalize its economy by getting rid of the complex system of licenses, permits, and controls that was suffocating the Indian economy. Now, the Indian state took a back seat and allowed private companies and markets to flourish. India also gave up the policy of import substitution, which is trying to manufacture everything at home and embracing foreign trade. Now, considering Mr. Rangarajan is also the ex-RBI governor, he said that the Indian banking system had done very well thanks to the decision to allow private banks. He stressed the need for the competition to ensure that public banks survive and grow. Very interestingly, Mr. Rangarajan also spoke about how India can become a developed country. He said that our per capita GDP has to grow from the current level of about 2,500 USD to about 13,000 US dollars. To achieve this, the Indian economy has to grow at about 7% consistently, and our investment rate as a percentage of GDP has to increase to 35%. Currently, this is at about 33%. He also further highlighted that the recent increase in the investments rate has been due to government expenditure and has been accompanied by an increase in fiscal deficits. He said that government investment is not the answer, and the government must create an investment-friendly environment where the private sector can invest heavily and be the dominant source of investment. Second, on development, he said that the government must adopt a multi-dimensional strategy. He said that the Asian tiger countries of Hong Kong, Taiwan, Singapore, and South Korea adopted a one-dimensional economic growth model that focused solely on export-led growth. He says that this model is no longer possible in today's world because advanced economies are not growing as fast as they were in the 1960s. There is also the fact that advanced economies, including the US and Europe, that championed free trade for well over half a century, are ironically becoming protectionists. This means that export-first strategy will no longer work for India. Third, the other and perhaps the most important thing he said in the interview was about India's monumental challenge with jobs. He said that employment in India is not growing as fast as income is. He went on to say that while jobless growth is bad, jobs without growth is also not sustainable. He also said that new technologies will only make the problem worse. He also said that new technologies will only make the problem even worse and government jobs are not the solution. All in all, this was a very fascinating interview and I really recommend you to watch it in full. You can find the link to this video in the Daily Brief newsletter.
Now let's move on to the second story and discuss if India is open for business. India is at a stage where if it has to achieve its potential, it needs to do a lot of things. We need to learn how to build and manage world-class businesses, working with cutting-edge technology, and then produce products and services that can sell in the best markets. And most importantly, we need lots and lots of money. Today's advanced Western countries took over 2 centuries to get where they are. But for the last 50 years or so, there's been a shortcut. And that shortcut is foreign investment. Foreign investors supply the funds necessary to build factories, logistics networks, invest in research and development, and everything else that India will need for its own development. But they also bring in knowledge, teaching Indians the best ways to do business from the experience they've gathered across the world. Many of Asia's economies that have grown spectacularly, like the Asian tiger economies of South Korea, Hong Kong, Taiwan, and Singapore, got to where they are due to massive foreign investments. India is trying to follow this playbook too. Its journey has been far from straightforward though. Before the global financial crisis, India had seen a sharp, steady increase in foreign investment. This trend abruptly reversed after 2009. FDI as a share of the Indian economy has never recovered to the same levels. While foreign investments hasn't kept pace with India's growing economy, in absolute numbers, investment into India was still looking upward. Gross investment inflows, which is the money investors put into India, hit a high of 84.8 US billion dollars in the financial year 2022. But then things reversed. Last year, direct investment into India was at 26.6 billion US dollars, which was the lowest India has seen since financial year 2007. This was for two reasons. One, the money coming into India had fallen substantially to 71 billion US dollars. Two, investors pulled out 44.4 US billion dollars out of the country, almost twice as much as they had before. There are many reasons for this decline. For one, the global economy has changed. Globalization is on the retreat in many parts of the world, and the global economy has seen serious headwinds over the last few years. But that doesn't explain everything. While global FDI fell 2% in 2023, investments into India fell by 43% over the year. In 2022, India got the eighth most investment in the world. In 2023, it dropped to 15th. Its share of global investment has also fallen substantially in the last couple of years. Here's India's big challenge. You can't force foreign investors to do anything. They don't live here, and India isn't entitled to their money. The only way to attract them is to make India a great place to do business. It isn't enough to show them how large a market India is. They need to believe that India's regulations and policies will allow them to be stable and help them flourish, and that the government won't create unnecessary headaches for them. The Indian government, unfortunately, is known to make things hard for businesses. Despite the liberalization of our economy a few decades ago, businesses still need to crawl through miles of red tape to get anything done. Just in the last couple of months, tax officials have gone after numerous companies for trivial issues, like sister companies in a conglomerate using the same name. India has also not been a fan of investment treaties that safeguard foreign investors. In 2016, it cancelled 76 of its 83 bilateral investment treaties. Now, there's some good news. In financial year 24-25, so far things have been much better than financial year 23-24. In the June quarter of this year, gross investment inflows into India were at $22.5 billion, up from $17.8 billion in the same quarter last year. Net FDI as a whole jumped up from $4.7 billion to $6.9 billion. At the same time, though, investors withdrew $6.7 billion from Indian markets in June 2024 alone, the most they have ever in any month on record. So, do you think we are finally heading towards more investment, or are we just scaring investors away? It's hard to know for sure, but one thing's clear. We need a lot more investments than we are getting. Now let's move on to the second story and discuss Zomato's acquisition of Paytm's ticketing business. Zomato just made a big move by acquiring Paytm's entertainment and ticketing business for over 2,400 crores. By the way, this is an all-cash deal. This acquisition isn't just a random purchase, it's a strategic step that could benefit both Zomato and Paytm in different ways. For Paytm, selling this part of their business allows them to zero in on what they do best: financial services. Plus, with regulatory pressures on their backs, this cash will help them keep shareholders happy, at least for a while. For Zomato, this is about more than just adding another business to their portfolio. They've already entered new markets like quick commerce through Blinkit. Now, with Paytm's movie and event ticketing business, Zomato is aiming to become the go-to app for all kinds of going out experiences, complementing their existing dining out unit, which makes up a small but profitable part of their revenue. In their recent quarterly results, Zomato's management spoke about how they see potential in the going out space. They mentioned that their dining out business, which helps people discover restaurants, is already profitable and has a run rate of over $500 million in annualized gross order value, or GOV. But they don't want to stop there. They're planning to expand into other areas like movie tickets, sports events, live performances, shopping, and even staycations. To make this vision a reality, Zomato is planning to launch a separate app called District by Zomato, which will focus solely on these going out experiences. They're taking a page out of the Blinkit playbook, building a separate brand and app, but still leveraging the traffic they already have on the Zomato platform to keep customer acquisition costs low. According to Motilal Oswal, the take rate for this new business could be around 12%, although it might vary depending on the type of offering. For instance, movie tickets might have lower commissions, while exclusive rights to major sports or live music events could bring in much higher fees. Will this be another sixer like Blinkit or a repeat of Zomato Legends shutdown where people could order iconic and famous dishes from other cities in India? Only time will tell. Thank you so much for listening to today's episode. We love producing this show to explain what's happening in the world of finance and business. If you like the show, please hit the like button on YouTube. If you are listening to this on Spotify or Apple Podcasts, please leave a rating. Also, we don't mind if you share this with your friends. That's it for today's episode. We'll see you in the next one.